Many of us are searching for a way to accelerate our journey toward big life goals. Whether it's a down payment on a house, a child's college fund, or a comfortable retirement, we want our money to work harder for us. So, it's easy to be drawn in by the promise of high-yield investments. The term Rogers high yield has been generating a lot of buzz. You've probably seen it mentioned in forums, articles, or maybe even an ad. But can this type of high-yield investment strategy truly be the engine that powers your long-term financial dreams? It's a question that requires a careful look at both the potential rewards and the very real risks involved. The allure is obvious. A higher yield means your money grows faster. Instead of waiting decades for compounding to work its magic, you could potentially reach your goals in a fraction of the time. This is particularly appealing when you're thinking about something like a child's education, where the timeline is fixed. A higher yield account could mean the difference between a state school and a private university. However, a critical truth in finance is that with high potential rewards comes high risk. High-yield investments, like junk bonds or certain emerging market funds, are often volatile. They can be incredibly sensitive to economic shifts, interest rate changes, and company-specific news. A major downturn could wipe out a significant portion of your portfolio just as you're nearing your goal, leaving you with less than you started with. The key to using any high-yield strategy for long-term goals isn't just about chasing the biggest numbers. It's about a balanced approach. Diversification is your best friend. Don't put all your eggs in one basket. By spreading your investments across different asset classes, some stable, low yield, and some higher yield, higher risk, you can mitigate potential losses. Another crucial factor is your timeline. If you have 30 years until retirement, you have more time to ride out market volatility and can afford to take on more risk. If your goal is a down payment in the next 2 to 3 years, a high-yield strategy might be far too risky. The potential for a sudden drop just before you need the cash is too high. Ultimately, Rogers high yield or any similar strategy is a tool. It's not a magic bullet. It can be a powerful part of a well-structured plan, but it shouldn't be the entire plan. Do your research, understand your risk tolerance, and always remember that a strong financial foundation is built on smart, diversified, and patient investing.